Capital efficiency is a term that is increasingly heard in startup circles, but what is it and why should I care about it? Capital efficiency is all about capital allocation within a company and finding the best fit of funding that meets the risk-return profile of what it's being used for, be it equity, debt, revenue-based loans, or any other type of financing. For a long time in startup circles, funding was all about equity. Companies would raise seed, Series A, Series B, and so on from venture capitalists, taking a round of dilution each time. And that was just the way things worked. Debt financing was not really readily available to early-stage startups due to the riskiness of the stage of the company and lack of assets and cash flows to lend against. Over the last 20 years, venture debt has become available to companies backed by recognized VC funds, with companies typically able to borrow around 20% of the amount of equity raised as a term loan. And in recent years, companies like Pollen VC have created new lending products that enable companies to access debt financing at a much earlier stage in their life cycle. So capital efficiency is about funding the right projects with the right sort of funding. So let's look into a couple of examples. A seed stage gaming company has spent $1 million developing a game that hasn't worked out. The founders are convinced that if they are able to license a more recognized IP for the game, it could be a great success. And so they approached their existing investors and raised another $1 million to fund the second game. This was a risky project that didn't have a certain outcome. Therefore, they funded it with venture capital. Equity funding is all about high risk and high returns, and raising equity capital is dilutive for founders and therefore thought of as expensive money. VC funds typically seek to make a multiple of their money back in an investment for taking substantial risks. Series A gaming company is considering its options for scaling up its mobile game. They are profitable and still have $2 million left in the bank, and most importantly, have figured out a user acquisition formula that works and is scalable. They are able to make a consistent return on their UA dollars of 15% per month. They are looking to demonstrate to their VCs that they understand capital efficiency and want to deploy their VC dollars as wisely as possible. So this company puts in place a credit facility that allows them to fund as much UA as they are able to buy profitably, all with debt. The 1% per month cost of debt yields them 14% monthly return after factoring the cost of serving the debt. Because the risk profile of funding the user acquisition is well understood, the studio is able to fund their UA growth with debt rather than equity. So the founders are able to scale without raising additional equity to fund their UA spend, saving them from unnecessary dilution. That's not to say they won't raise more venture capital funding, but when they do, they need to raise less and at a higher valuation. Smart VCs are into capital efficiency. It benefits them as the external leverage gets better fund returns. They can achieve the same results with less capital invested, which improves their IRRs to their LP investors. So with a smart approach to capital efficiency, everyone wins. Message to founders: use debt or revenue-based financing when risk is low and return is more certain, and use equity for funding high-risk projects where capital is truly at risk.